Hello everybody and welcome. My name is Francesca and today with Sakib we're gonna walk you through our SPHR entertainment analysis. But this is not the first time that we do so. We've already done this and you can go on our YouTube channel and check it out. Now let's start, and we're gonna start with the company portfolio because since last time we talked, few things have changed. The current company portfolio of SPHR Entertainment is composed by SPHR segment and the Madison Square Garden Networks segment. But I just want to refresh your minds a little bit on what's actually SPHR. SPHR lit up the Las Vegas sky for the very first time in July 2023 and then opened to the public the following September. This spectacular venue boasts a 580,000 square foot LED exterior and a breathtaking 16K resolution display that wraps around and over the auditorium, which is called the Exosphere. With nearly 18,000 seats, SPHR provides a truly immersive experience. As a matter of fact, the venue has the ability to alter the temperature, create wind, and even deploy scenes, offering a 4D experience for all the attendants. SPHR sound system is powered by Holopot, a Berlin-based manufacturer. This system comprises 167,000 loudspeakers drivers, delivering unique audio quality and precision. But now let's see what we have done so far with SPHR. Initially, we rated the stock as a buy, since the price of SPHR represented a remarkable 56% discount on the initial projected cost of the venue. The underlying asset of SPHR held significant value, providing a layer of security for the investment. Additionally, the venue itself was revolutionary, showing growth potential. After a while, though, we shifted towards a hold. The project had a remarkable 75% increase in its stock price. SPHR reaffirmed its construction cost at $2.3 billion. This was a substantial relief for the market, which had been concerned about potential cost overruns. However, we noticed a continuous decline in MSGN subscribers. Moreover, there were a few uncertainties around the companies, such as the non-recourse loan on MSGN maturing in the next year, on which the CEO Dolan did not provide any significant update. Also, there was a lack of clarity on the sponsor for SPHR, raising further concerns. But now, talking to the present, SPHR Entertainment reported consolidated revenues of $321.3 billion for the third quarter, making a significant achievement. They also reported an operating loss of $40.4 million, which is a substantial improvement of $61.5 million compared to the year before. But it's the adjusted operating income which makes the difference. It's been reported of $61.5 million compared to the adjusted operating loss of $18.7 million in the same quarter the previous year. This indicates a strong turnaround in profitability. Focusing now just on the SPHR segment, it reported revenues of $170.4 million, an excellent achievement which was supported by the events-related revenues from performances and revenues from sponsorship, the Exosphere advertising, and suite license fees. The operating expenses from this segment were quite notable at $62.3 million, reflecting the costs associated with running these events and venues. Advertising saw an increase of 31% since the year before, and SPHR operating loss was $83.5 million, an improvement of $28.9 million compared to the year before, mainly due to the increase in revenue and the less restructuring charges. Shifting our focus now on the MSGN segment, it reported total revenue of $151 million, a decline by 6% compared to the year before, mainly because of the reduction in advertising revenue and the distribution revenue due to the decrease in subscribers. The operating expenses increased slightly to $91.7 million, mainly driven by the higher programming and production costs. Despite the revenue decline, though, MSGN managed to achieve an operating income of 43.1 million, largely due to lower administrative expenses. However, though, the adjusted operating income fell by 17% to 48.6 million, reflecting the overall revenue decrease and increased operating costs. Despite these challenges, precisely in the MSGN segment with the revenue declines, Sphere Entertainment as a whole showed resilience and improvement in its financial metrics. The significant increase in the adjusted operating income suggests a promising future, particularly for the Sphere segment with its diverse revenue streams. Now, for a more detailed valuation, I'm going to give the floor to Sakib.
Thank you, Francesca, for the introduction of Sapphire. Let's dig a bit deeper into what we've done so far with Sapphire. Initially, when we looked at Sapphire in the June of last year, I guess it was still under construction. All of that is very well covered in our first video and in the first article. The link to both of them should be in the description. But as a summary, at that time it was still under construction. It looked like a deep value play at the time. The construction cost at the time was like $2.3 billion. The market implied valuation for the Severe project only was like 500 million or something like that. Of course, we should not compare the market's valuation with the construction cost, because the value of any asset is what it can earn. So then we tried to look at the earnings capability of Sapphire. Sapphire looked like a very unique project. I mean, outside was fully covered with LEDs. The advertisement running on them could be seen from the planes. The inside, the sound technology, the screen technology, it was in 16K resolution. Sound technology, the company which an update, the company which was providing sound technology at that time has now been acquired by the Sapphire. So, the earnings, the EBIT or the operating income or the EBITDA required to justify the valuation at the time for Sapphire was very low, and the earnings capability for Sapphire were way high. I mean, we analyzed that and we immediately realized that the earnings capability for Sapphire are way above than what the market is anticipating. After that, they lit Sapphire for the first time, and the market started to realize that what a huge thing Sapphire is, and its potential. I mean, it was an unbelievable project, and the stock started to re-rate really quickly. Um, after a couple of weeks, when Sapphire was lit for the first time, we went up on our original position by like 75%. Although, initially we also had some reservations, but at the time of our first report, Sapphire provided a huge margin of safety because it was way below than its true asset value. Um, you know, so that provided a lot of margin of a lot in the terms of margin of safety. But as it went up 75%, the margin of safety went on being narrower and narrower, and the issues were still there. Our reservations were still there. Sapphire still hadn't issued any quarterly earnings covering the full performance of Sapphire. I think Sapphire, by the time we sold, was open for like a couple of weeks, I guess. Um, so we wanted to look at the Swiss numbers, how it can do after 75% re-rating into the stock. The story as a pure deep value play was almost gone. We wanted to look at the growth potential for Sapphire. We wanted them to answer some of our reservations. Which are the reservations we had with Sapphire are very well covered in the risk section of the first report. Anyone who wants a deeper understanding of those things can visit our first report. So to name a few, uh, London project was being initiated by Sapphire. They were trying to build that project on their own. At the time, we were seeing some of the reports coming from London, from the media, that the British people are not really happy about Saphir. They were complaining that it will be too bright for them in the night, and so some of them were even protesting. And also on top of that, Saphir Entertainment was trying to build the second Saphir by themselves. So we were a bit skeptical of that. So uh, after that, the other reservation for us was the MSGN's debt. MSGN was highly leveraged. MSGN's revenue, operating margins were all going down. Um, the story about MSGN seemed like a lost case. The good thing was that, which you can also see in our valuation for Saphir, in the first report, that we put we implied a zero valuation for MSGN because the debt for MSGN was recourse only to MSGN. So yeah, we used a zero valuation for MSGN and tried to value only the Saphir segment of the company. After that, our problem was we were unsure of what the CEO and the management might do at the end, because we we had thought at the time that some of the cash from Saphir will be used, or might be used, to pay off some of MSGN's debt. So that reservation was a big problem for us. I mean, we were very unsure, and looking at the past history of the CEO, his past history of restructuring the companies was very worrisome for us. Again, CEO's past history and his past restructurings were done. Uh, against the benefits of the minority shareholders. The minority shareholders always suffered after his restructuring of the company. So that again was one of the reservations. And after the stock had gone up 75%, we decided to sell. So after that, coming to now, we again have an update on Saphir. Um, Saphir has now launched two full quarterly reports covering the full performance of Saphir, and they have almost answered all of our reservations. We've seen the numbers, which look really good. So let's start with some of the updates. As I said, the London project, our first reservation, right? Um, it's not there anymore. We were proved right at the end. The British media, the British people, they were protesting, and at the end, the project didn't get approved from the local municipal committee. So they had to scrap that project, and that proved to be a blessing, because now Saphir is trying to expand through a franchising model instead of building new Saphirs on their own. So franchising model will have less construction costs for them. It's more efficient. It's less worrying for us as an investors. So that's a beautiful development for us at least. After that, the MSGN's debt, we were again proved right. In the last earnings or the earnings before, the management confirmed that some of the cash from the parent will be used to pay off some of MSGN's debt. That triggered a huge reaction in the market. The stock went down a lot, and rightly so. But when we look deeply, we understood that they're only trying to I mean, yes, they are using parents' cash, so now MSGN's implied value for us is not zero anymore. It's negative something. That negative is what parent will be paying towards MSGN's debt. So now they are trying to refinance the debt for 1 year, but they are looking at some strategic initiatives to deal with MSGN. That's that is a blessing in disguise. I mean, they've finally accepted for the first time that they need to do something with MSGN. It's not there anymore. I mean, so that payment from Saphir, that one-time payment, will prove to be a blessing. A, a, a blessing. So, I mean, after using MSGN's own cash, they will pay something from Saphir towards MSGN's debt, and they'll refinance the rest for 1 year. And that new debt will also be recourse only to MSGN. So, um, yes. Saphir is paying something, but overall, it's good that they finally accepted the fate of MSG and they need to restructure it or look at some other strategic initiatives for it. So that's there goes our second reservation. Third one was regarding Dolan's the CEO Jamie Dolan's own history of doing different things which impacted minority shareholders. Looking at at the developments of the past few months, we saw that Dolan was buying very aggressively in the open market. He was buying between $40 to $46 and bought a huge amount of stock. And just a few weeks back, he changed his compensation structure from a huge fixed salary towards more of a compensation of a stock compensation style structure for for all of his companies, not just Saphir, MSGE, Saphir, and some other as well. So these this new development is very positive because it aligns his interests with the interests of the minority shareholders. So for us, that's a very positive development. So all of the reservations that we had, we wanted to wait, we wanted to get more clarity on them, and finally we got that clarity. So after um, getting answers on our reservations, we wanted to look at the numbers now for Sphere. Sphere reported a positive adjusted operating income of 12.9 billion, as Francesca said. So, the impact and the true meaning of this positive AOI, they reported it for the first time. The Sphere segment reported it for the first time. I mean, the implications are huge, guys. I mean, previously, analysts were expecting it to be positive by the end of 2027 or 2028, I believe. But now, it's just in its second full quarter of operations, it reported a positive AOI. It's expected to now post a positive EBITDA by the end of this year. It's moving a lot faster towards profitability than the market was initially expecting, and that's very positive for us. In terms of moving on to the valuation, in terms of valuation, we did not try to be scientists here. We did not try to come up with sustainable revenue to calculate earning power value, which is our preferred mode of valuing companies, or we did not try to come up with the working capital and capex numbers for the next 10 years to do the DCF. We just relied on a very simple style of valuation. We used a multiples based approach. We used 2026 analyst average consensus for the EBITDA for 2026 applied a 15 times multiple. It seems fair given the unique nature of Sphere. And after that, one of the other adjustments that you'll see in the valuation table is Sphere's payment for MSG instead, which we are assuming to be 250 million. This 250 million is quite conservative. I believe the final payment will be less than that, but we're going with the conservative number. So adjusting for that, we get adjusting for that the remaining Saphir's cash and Saphir's debt, putting MSGN at zero because the new loan will also be recourse. So finally, we get a valuation of $61, um, which gives us an annualized update of 24%, I believe. Now, initially, it was like annualized return was like 30% for us when we initially invested in the stock. But now I think at the time of this video, it's like 24%. All the time of the analysis was like 24%. So I mean, it's not a really great return. It's not a blockbuster. But guys, I mean, we have been conservative with our numbers, our multiple conservative number of the repayment assumption. So we have been fairly conservative with our numbers, and the downside risk here seems limited. It it does get a certain uh, a floor price, a certain spot from its tangible book value. And if you look at the sensitivity tables, the two sensitivity tables we made, the first one I think regresses the stock price against the repayment of debt from Superior and the EBITDA assumption. The second one is comparing EBITDA assumption and the multiple assumption. I think in both of them you'll see we have a very low downside risk. Coupled with a good healthy upside, 24 to 30%, very low downside risk. Um, moving from constructing their own spheres towards franchisee model, resolving finally accepting that MHGN needs that there's something that we need to do there, and thirdly, um, the issue with the management, that they finally now seem to be aligned with the minority shareholders. So looking at all of these things, we're now again rating Safir as a buy once again. Yeah. So thank you so much, guys. The links to the third article, which is covering our current position on Safir, will also be posted in the description. If you want to look at our history, the link to the first and second article, the first video should also be in the description. So feel free to ask questions, and thank you so much for your time.